What's going on, everybody? Welcome back to the channel. In today's video, we're going to be talking about a really scary chart that's been scaring the whole internet. That is the 2008 market crash compared to the current market crash that we're seeing, and how scary similar these two charts are. I actually made a TikTok on this a day ago, and within 24 hours, it got over 1 million views. And so many people have been messaging, DMing me, what were my full thoughts about this current chart. So I'm here to explain to you guys, what do I think? Is 2008 crash going to be very similar to the current crash that we're seeing too? Are there going to be similar results? And everything what I plan to do and my thoughts will be in today's video. So make sure you watch this whole video because it's going to be very, very important. As always, videos like this take me a long time to make and do a lot of research. I put a lot of statistics. I find a lot of things out that not a lot of people talk about, so I can bring you the most value in these easy to watch videos. So appreciate like, subscribe, and the comment down below. And as a reward for that, here's a picture of baby Zeus. So first, let's talk about why are these charts so similar? I mean, what happened in 2008 is much different from what's happening now. And that goes back to the trading psychology. And trading psychology is very real. This is why technical analysis work and why patterns repeat themselves. Because investors and traders out there are very likely to do the same things as their emotions get triggered one way or another. A lot of people think that day trading, stock charts, things like that, MACDs, RSI, all these indicators are based off math. And to be good at trading and investing, you need to learn numbers, do P ratios, equations, be a nerd. And it's actually not at all like that. Trading is much more of a psychology game than it is a math game. So if you understand psychology, you understand what investors are more likely to do. You understand their tendencies, their patterns, and why things like 2008 and 2022 look very, very similar. Now, we also got to keep in mind that the result might be the same, but the cause might be much different. And that's what I think we're seeing here now. Now, let's go back to 2008 for a minute and let's talk about why did that happen. Back then, we saw a real estate market crash that brought down the stock market. Well, I think currently we're seeing a stock market crash, bringing down a bit the real estate markets. Now, in 2008, we had huge balloon payments. So we had these people that couldn't afford their payments, taking loans from all these lenders that weren't doing the proper due diligence. They would get a $200,000 home, then after 5 years had gone down 20% in value, and they had a balloon payment on this home. So that means they had to come up with a difference of whatever the value of the home was, because the collateral wasn't enough to cover the payment. They didn't have the money. They had foreclosures. Bank couldn't afford all these foreclosures that were happening. The banks went out of business. People lost money, and a lot of bad things happened. Another huge part of what played in 2008 was home builders. In 2005, home builders were building enough homes to meet demand, which means supply and demand had finally been stabilized. So any homes that were built more than that were actually too many homes. So the supply had increased and the demand was staying the same. So all that happened from 2005 to 2008. So as many homes were being built, there's not enough people buying them. Now, currently, ever since 2008, that demand has never been met. And even to this day, the supply of homes being built is not catching up to the demand. Now, let's talk about currently what's going on right now. In 2022, we saw the main reason we're seeing a crash is because of two things: inflation and interest rates. And those two things go hand in hand pretty much. We're seeing a high inflation that we are not seeing in 4 years back in the 80s. Now, in 2008, inflation really wasn't that bad. And due to this inflation, we had to rapidly raise interest rates. And this quick increase of interest rates has really spooked the markets, both the stocks and the crypto, which has eventually brought down a bit the real estate market as mortgage rates do go higher. Now, the funny part is actually that the real estate back in 2006, 2008, the interest rates back then were even lower than what it is now. But the stock market from 2005 all the way to 2007 hadn't seen any issues as those interest rates were higher still. The main reason is because interest rates had slowly gone up, while currently we're seeing a rapid increase of those interest rates. In 2008, we saw the stock market crash 30% over the course of months, and it took way longer than it's taking right now. Currently, the stock market crashed between 20 to 30% within 6 months, which is much faster than we saw back in 2008, and that has been the way the interest rates have increased so quickly. There's a lot of different things that happened in 2008, but there's also very similar things. For example, very similar to 2008, our consumer debt is extremely high. So how much does a household have typical debt? Back in 2008, it was around $20 trillion, and currently it's $16 trillion. You're like, okay, well, that's $4 trillion difference. But actually, if you account for inflation, the money that would be considered 2008 would be around 16 trillion. So we currently get to that almost the same exact number that we had seen back in 2008, which could be very, very dangerous. As debt gets too much, people can't afford that debt anymore, and they may have to go foreclosure, file bankrupt, sell all their stocks, sell their real estate, and just a lot of bad things could happen. We're also seeing consumer fear being extremely high. So what is the likelihood of an average person to go out there and spending their money? We are seeing fear that we're not seeing since 2008, very mimically seeing those charts. And if you told me I was recently in the airport and I see all these people traveling, the airport is packed, everywhere I go, I feel like there's a ton of people at the restaurants, at the mall. So I'm like, okay, they're saying that all these people are scared. But when I go out for my experience, I'm like, man, all these people are spending money, especially traveling to Europe now. Everybody wants to take advantage of the USD and the euro being equal. I mean, the statistics say that people are scared of spending money, but when I go to the airport, that thing is friggin' packed. And if you've been to the airport, you know what I'm talking about. Delays, flights canceled, people everywhere. It's madness. Make sure you get your TSA pre-check. In reality, my overall point is that yes, the outcome might be the same, but I think the reasoning of where we're going to see an outcome of a long-term bear market and long-term recession is not because of the same issues. Two things can cause the same reaction.
Same, but different.
And 2008, I believe, was something, and what we're currently seeing is going to be different. Now, I don't think the real estate market is going to crash like we saw in 2008. I do think we're finally finding the equilibrium between buyers and sellers, and interest rates got much higher. We also have to take in mind that from 2020 to 2021, so many people took advantage of 0% interest rates, and those people were thinking, hey, why would I now move somewhere else? Yes, I do like in nicer homes, but why am I going to pay so much more when my interest rate is going to be so much higher when I have this really low 2 to 3% interest rate? Obviously, now you have all these people that have refinanced their home, have finally purchased their home. They're saying, hey, I'm not going to pay higher prices and an increased interest rates. So that's why we're seeing that demand of homes just go down week after week. And we're seeing prices of home going down week after week as well as home prices are being cut. My plan will always be the same, is to stay invested, find a good deal both in stocks, crypto, the right home to buy to start investing. It was the bear markets and the recession is actually the best time to invest as you're buying almost near the bottom. Now, will you ever be able to exactly time the bottom? No, you won't. That's why it's best to stay invested as much as you can. Of course, keep cash in hand to find the right deals and be very selective on where you want to invest your money. Now, I do think that we're still going to go into a longer term recession bear market in 2023. So in 2022, I see potentially us making another dip, then kind of trending higher, and in 2023 into 2024, going in a longer term recession, bear market, whatever you want to call it, like we saw in 2008. I don't think the reasoning is the same, but I think the cause and the effect of it all will end up being the same. So let me know in the comments below, what do you think is going to happen? Are we very similar to 2008? Are you investing? Are you not investing? Do you think this is all a hoax? Let me know in the comments below. As always, leave a like, comment, subscribe, and peace.